Bitcoin. The very word sparks a whirlwind of emotions, from fervent belief to outright dismissal. Yet beneath the volatility and hype lies a revolutionary technology with the potential to reshape global finance. Created in 2009, Bitcoin operates on a decentralized network called the blockchain. This digital ledger records every transaction, ensuring transparency and security without the need for a central authority like a bank or government. But what truly sets Bitcoin apart is its programmed scarcity. Unlike traditional currencies subject to inflation, Bitcoin has a fixed supply capped at 21 million coins. This digital scarcity is achieved through a process known as halving. Imagine a gold mine suddenly halving its output. The immediate effect would be a dramatic reduction in the availability of gold. The impact on the gold's scarcity, and therefore its price, would be significant. Gold would become harder to find, and its value would likely soar as a result. This is precisely what happens with Bitcoin every 4 years. Known as the halving event, it mirrors the gold mine scenario, but in the digital realm. The halving is a pre-programmed event written into Bitcoin's code. It's an integral part of Bitcoin's design, ensuring that the supply of new Bitcoins is controlled and predictable. Every 210,000 blocks mined, roughly equivalent to 4 years, the reward given to miners for securing the network is cut in half. This means that miners receive 50% fewer Bitcoins for the same amount of work. This halving mechanism effectively reduces the rate at which new Bitcoins enter circulation, creating a classic supply shock. The sudden reduction in new supply can have profound effects on the market. With fewer Bitcoins available to mine, the digital asset becomes more scarce over time. This increasing scarcity is a fundamental aspect of Bitcoin's value proposition. And as anyone familiar with basic economics knows, when supply decreases while demand remains constant or increases, prices tend to rise. This principle is at the heart of Bitcoin's market dynamics, driving its potential for long-term value appreciation. The first Bitcoin halving occurred on November 28, 2012. At the time, Bitcoin was a relatively obscure phenomenon, largely confined to tech forums and early adopters. Bitcoin's price hovered around $12 before the halving. In the months that followed, the price gradually climbed, reaching a peak of around $1,000 in late 2013. This surge represented an astounding 8,000% increase from the pre-halving price. While other factors undoubtedly contributed to this parabolic rise, the halving served as a catalyst, highlighting the potential impact of reduced supply on a nascent asset class. The second halving took place on July 9, 2016. Bitcoin had gained more mainstream attention by this point, but it remained a volatile and speculative asset. The price leading up to the halving was around $650. Over the next 18 months, Bitcoin embarked on an epic bull run, reaching an all-time high of nearly $20,000 in December 2017. This surge represented a staggering 2,900% increase from the pre-halving price. The 2016 halving demonstrated the growing influence of this event on Bitcoin's price trajectory, solidifying its reputation as a digital asset with significant upside potential. Section 5. 2020. Institutional appetite awakens. The most recent halving occurred on May 11, 2020, against the backdrop of a global pandemic and unprecedented economic uncertainty. The world was grappling with lockdowns, market volatility, and a shift in economic paradigms. Bitcoin had matured significantly since its early days, attracting interest from institutional investors and corporations. These entities began to see Bitcoin not just as a speculative asset, but as a hedge against inflation and a store of value. The price leading up to the halving was around $9,000. This was a significant increase from previous years, reflecting growing confidence in Bitcoin's long-term potential. In the months that followed, Bitcoin embarked on another bull run, reaching an all-time high of over $68,000 in November 2021. This bull run was driven by increased demand from both retail and institutional investors. This surge represented a remarkable 650% increase from the pre-halving price. Such a dramatic rise underscored the growing acceptance and validation of Bitcoin in the financial markets. The 2020 halving showcased the growing institutional adoption of Bitcoin, further solidifying its status as a viable investment asset. Major financial institutions, hedge funds, and even publicly traded companies began to allocate portions of their portfolios to Bitcoin, signaling a new era of mainstream acceptance. To fully grasp the halving's impact, let's examine the numbers in detail. The following table summarizes the percentage gains observed after each halving event, providing a clear picture of the exponential growth. The first halving on November 28, 2012, saw an increase from $12 to $1,000, marking a significant milestone in Bitcoin's history. This represented a staggering gain of 8,233%, a figure that caught the attention of many investors. The second halving on July 9, 2016, saw an increase from $650 to $20,000, further solidifying Bitcoin's position in the financial world. This time, the gain was 2,900%, still an impressive return on investment. The third halving on May 11, 2020, saw an increase from $9,000 to $68,000, showcasing the continued interest and trust in Bitcoin. This resulted in a gain of 655%. As the table illustrates, each halving event has been followed by a significant price appreciation, reflecting the market's reaction to the reduced supply. While past performance is not indicative of future results, it provides valuable insights. The historical data suggests a strong correlation between halving events and Bitcoin's price trajectory, indicating that these events play a crucial role in shaping the market dynamics. Predicting Bitcoin's future price is a fool's errand. Countless factors can influence its value, from regulatory changes to technological advancements to broader market sentiment. However, the halving remains a significant event with the potential to impact Bitcoin's scarcity and, therefore, its price. Some analysts predict that the next halving, scheduled for 2024, could propel Bitcoin to new all-time highs, potentially reaching $100,000 or even $200,000. Others remain more cautious, citing potential headwinds such as regulatory uncertainty and competition from other cryptocurrencies. The halving's impact extends beyond Bitcoin's price. It also affects the miners who secure the network. As the block reward decreases, miners receive less Bitcoin for their efforts. This reduction in revenue can force less efficient miners out of the market, leading to increased centralization of mining power. However, it can also incentivize innovation, pushing miners to develop more efficient mining hardware and explore alternative energy sources. The world is witnessing a paradigm shift in finance. Bitcoin, with its programmed scarcity and decentralized nature, stands at the forefront of this revolution. The halving events, with their potential to impact price and shape the Bitcoin ecosystem, are crucial moments in this ongoing saga. Whether you're an experienced investor or a curious observer, understanding the halving's significance is paramount to navigating the exciting and often perplexing world of Bitcoin.